Recently, New Zealand First proposed that the Crown should purchase BNZ from its Australian parent, National Australia Bank, and merge it with Kiwi Bank. At first, this sounds like a banking policy, but actually, it is a much bigger debate about economic sovereignty, fiscal discipline, and national capital allocation. New Zealand First's argument is that New Zealand's banking sector is heavily concentrated among four major Australian-owned banks: ANZ, ASB, BNZ, and Westpac. The Commerce Commission has also found that the major banks do not face strong competition in personal banking, so the strategic logic is understandable. A larger New Zealand-owned bank could become a stronger competitor and a national counterweight in the banking sector. But the financial scale is significant. If BNZ cost around 16 to 20 billion New Zealand dollars, that would be roughly 9 to 12% of 1 year's government revenue. If the cost reached the political estimate of around 30 billion New Zealand dollars, it would be about 18% of annual government revenue. As a rough estimate, if fully debt-funded, a 20 billion New Zealand dollar deal could lift net core Crown debt by roughly 4 to 5 percentage points of GDP, from about 41.8% to around 46% of GDP. A 30 billion New Zealand dollar deal could push it closer to 49% of GDP. That is a very large capital allocation decision for a country still trying to move from deficit back to surplus. The key question is not only should New Zealand own more of its banking system, the real CFO question is, can the government purchase BNZ at a reasonable price, fund the deal responsibly, meet regulatory capital requirements, and generate a better long-term public return than other uses of Crown capital? National's concern is that buying BNZ could require tens of billions of dollars of additional borrowing. That would increase Crown debt and may reduce fiscal space for hospitals, infrastructure, education, tax relief, public sector investment, or debt reduction. There are also execution risks. Merging two banks is complex. Systems, staff, culture, customer service, regulation, technology platforms, and risk management all need to be integrated carefully. Ownership alone does not guarantee better competition or better customer outcomes. The recent Consumer NZ Banking Survey also adds an important warning. Kiwi Bank's trust score was reported at 70%, below the sector average of 75%. This suggests the issue is not only market share. A larger New Zealand-owned bank would still need to grow sustainably by improving customer value, service quality, fair pricing, digital capability, and trust. Otherwise, the merger may create a bigger bank, but not necessarily a better bank. So my view is balanced. Strategically, the idea has merit because banking is critical national infrastructure. A stronger New Zealand-owned bank could improve competition, retain more financial decision-making in New Zealand, and create a larger New Zealand-owned counterweight to Australian-owned banks. But financially, the proposal needs a very strong investment case. Before supporting it, I would want to see 6 things: a valuation report, a funding plan, a debt impact model, a regulatory capital assessment, a competition test, and an independent governance structure to avoid political lending. In simple terms, the BNZ buyback debate is a trade-off between economic sovereignty and fiscal discipline. A future-focused government should not reject strategic ownership emotionally, but it also should not spend or borrow tens of billions, without proving that the return, risk, and public benefit are better than the alternatives.